All right, welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Now let's make some money and hopefully get a heck of a lot smarter. But before we do all that, really want to provide some hot market analysis on really one big story of the day. And today that is Walmart reportedly dumping its entire stake in Chinese e-commerce play JD.com for $3.6 billion. I'm here to say or offer up three reasons why this is a great/amazing news for investors. First up, who cares about this business? The U.S. business for Walmart is rocking. Same-store sales up in 4.2%. Walmart does not need to have a stake in a Chinese e-com play. Number two, international business for Walmart also rocking. These are the stores the company actually owns, like a Sam's Club operating in China. Most recent quarter, Walmart international business sales up 7.1%. Operating profits are up, income up 15.7% year over year. China business up very strong as well. And last but not least, this is another way or another example of Walmart CEO Doug McMillon and CFO John David Rainey, JDR, just taking a more streamlined approach to looking at the business, cutting costs and figuring out ways to take capital from other investments invested in growth areas of the business like U.S. e-commerce. You're welcome. Now let's get all into really the heart of this opening bid episode. Got a couple cool special guests with us here today. BlackRock Global Chief Investment Officer of Fixed Income, Rick Rieder. Good to see you as always. And really, I would say the star of market domination, Yahoo Finance's really most watched, or one of most watched shows, Julie Hyman. I know you're always up, Julie, early, rocking the market, so good to see you here.
Yeah, I'm not usually in the office this early anymore. I used to be. But I'm happy to be here.
Well, don't burst the magic. I was going to sell you on how you're in the office really at 5 a.m., Julie.
I am up early.
You're up early. And Rick, you don't sleep at all. Are you still studying markets at 3 a.m.? Are you still up trading?
I trade between 4 and 6 in the morning. And I work out during that time, and then.
Wait, you work out and trade at the same time?
No. So I get up, I do some trading, then I work out, and then I do a little bit more. But that time, I'm actually convinced that that's the best time actually in the markets because it beats when Asia's closing and New York is not open yet. And I always feel like the markets do extreme things and you can take advantage of it. So,
do you ever have the fear of missing out, like you're missing something in markets?
So do you know that once they tested my stress levels and they said to me that between 11 and 4 a.m. is when your stress is highest. And I said, how can that be right? I'm sleeping. They said, it's actually when you have your phone in your hand is when you're most relaxed. And when I don't have it from 11 and 4, they said that's when my stress level
that
goes
is
up.
incredible.
Isn't that strange? So sleeping, I guess, is a stressful thing.
No, it's for me too. Julie, you've worked with me for a while. You know that.
Yes, I do know that.
So so you wake up in the morning, what do you trade first? Like, what does that screen look like?
So, I mean, first thing I look at rates, I look at where equities are and currencies. And so usually, I would say more times than not, you get a rate move in the morning. That's some rumor or something. And because the markets aren't terribly liquid, almost always they overreact to it. So I tend to try and but you can't really trade big size. But usually the markets give you an opportunity to do something in rates. And then sometimes, equities move on some rumor overnight. Like I say, it tends to be extreme. So I almost always, if the market, whatever it does, up or down, I almost always go the opposite way because it tends to be exaggerated. So anyway, so it also helps us do a little bit of positioning early in the day.
Yeah. So how much of that trading you're doing first thing in the morning is for work, are you also trading on your personal?
No, 100% for work. Yeah, 100% for work. Yeah, and like I say, I mean, if you actually took the sheer size, it's actually not that big size-wise because the markets just aren't receptive at that time of the day. But anyway, it gets you, certainly gets. I mean, I found over a year. You make a little bit of money each time when you do things like this, and I am a big believer is just keep doing it, try and find places you make a little bit of money, and at the end of the year, hopefully it adds up.
What do you make of this market calm that we're seeing?
The market around?
Yeah, it's just things seem to have calmed down after that really harsh reaction from that jobs report a couple weeks ago.
I'm pretty blown away, actually, that so you think about, was it extreme? It was extreme. And you think about, always try and interpret what happened and what drove that. The carry trade, the Japanese dynamic, they had a weak unemployment report, and right before that, the Fed wasn't, clearly didn't suggest they were going to move aggressively. But it was that, think about what an overreaction to that. By the way, it was the same level of volatility that period, that Monday, as you saw in the pandemic and the financial crisis. That's the only time you hit those sort of levels. That was extreme. The fact that you've come all the way back has been surprising to me, and that you still have geopolitical, you still have Jackson Hole, you still have an election, you still have an economy that's moderating, although we've got some data that's better recently. So yeah, I'm pretty surprised. I mean, quite frankly, I've been buying volatility. I mean, I'm buying call options on the equity market. We've been turning some of our equity positions into, I don't have to get too complex around it, into call options, selling some puts, because volatility's dropped down again, that you can actually turn your portfolio into a much safer portfolio by buying, I mean, the VIX at such low levels. We bought S&P call options at 11 vol. Like, that's unbelievable. We were at 6, the VIX was 63, 64. So anyway, so we're trying to take advantage of that.
Does the fact that calm has returned so quickly suggest that maybe even though that jobs report was the spark, that really a lot of what was going on was the unwind of the carry trade and the short vol trade, that it wasn't really that people were fundamentally that worried about the economic underpinnings?
I think that's right. I mean, that one thing you realize about markets is there is a lot of gearing, a lot of leverage that can get into some markets. There's a lot of crowding, more than I've ever seen in my career. And, there's this whole series of reasons why there's crowding. I think, I say like today, I don't know if it's the advent of social media, but people tend to all do the same thing about how 7 stocks drive the market. I was looking at volumes, like the top 2 or 3 stocks, relative to everything else. Markets just there was this concentration of activity and crowding, and I agree with you. I think what happened was this: there's a lot of people who are long Japanese equities. We like Japanese equities, but a lot of it was on gearing, and then all of a sudden, you watch the floor come out from it. And you walk in the morning, or as we were talking about earlier in the day, and the Nikkei down 12%, trading in a 20% range. That's a developed market, equity market, but it's all about you get these crowding positions and then unwind quickly. And I would say one thing about markets I've learned over the years: they go down 5 times faster than they go up. When markets go up, people take profits. It tends to be more stable. When it goes up, people don't like losing money. They get out. Mm-hmm. And it was that was an embodiment of that on that Monday.
Well, and is that, talking about going contrarian, as you were discussing earlier, is that usually a mistake to sell into selling?
It's a funny thing it's funny you brought that up, because I've been thinking about that a lot recently. Because you have so much momentum activity, my business, quite frankly, and a lot of how I think about the world, is things tend to move around if you identify the regime you're operating in, things tend to oscillate around that trend. And then what you try and do is, when you get oscillations above or below, you tend to go the other way, because you're probably going to get back on the trend line. So, my whole career is try and sell the highs, buy the lows. But some of what happens in momentum now is it can go for a longer period of time. So you've got to sort of extend the range of which you're doing that. And so I like, we call it counter trade the market. But you've got to extend, and you got to think about, gosh, some of these things, like think about tech or semis, AI, like how long that went on for. So it's hard to counter trade that. So, what you think about is when you hit extremes, that's when you do it. But you got to extend the range that you're operating within that.
Rick, what do you think is the most important short-term factor in markets? Is it Nvidia's earnings report, or is it the next Fed meeting?
They're both important. I think if you said over the next few weeks, we go in, there's a few things happening. It's a tough seasonal. We're going to get through a pretty good seasonal. September, you get a lot of supply that comes in. The employment report, what the nature of slack in employment and labor is going to be important. So we've got our eye on that. Obviously, everything that's around the election, because of the dispersion of policy. So those things are all big. But yeah, Powell is going to be interesting. My sense is he's going to try and thread the needle of, we're going to look at the data and determine, I think he's going to say that we're going to start an easing cycle or set up the markets for that, although they've already priced in 3 and change cuts, almost 4 cuts for the year. So that, that's going to be important. But yeah, Nvidia is going to be a big deal. And but I think we're going to get in September, and elections, supply, seasonals, those are going to be pretty significant.
If we get another, and we were talking to Goldman's chief economist, Jan Hatzius, about this, and he brought up a good point. If the next jobs report disappoints, it could open the door for a 50 basis point rate cut at one of its next meetings. Do you subscribe to that?
So he's very, very good. I will say one thing. I think his projection, his base case is 325. There's 25s in 3 successive meetings. My sense is that's right. But yeah, you can't price out of the markets. Have priced pretty much have split the difference between a 25 and 50. I would do 50. I think you got to get the funds rate to 4% quickly. And, you can't. I was looking yesterday at credit card delinquencies or charge-offs, auto loan delinquencies. Like, you're starting to see numbers that approach financial crisis. Not there yet, but you're starting to see this significant increase. 5 3/8 when you've got inflation running. I mean, I was looking at 3-month moving average. A bunch of the metrics are under 2 now, are under 2. 5 3/8 when you got inflation running, let's say 2, the wrong price. Like, get it to 4, which is still restrictive. So could they do it? I think they should. Do I think, I have enough difference of opinion on that committee that they probably will say, let's compromise and do 25s consecutive meetings? I think that's Jan's base case, and that seems right to me.
All right, hang with us, guys. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. Fun chat here with BlackRock Global Chief Investment Officer of Fixed Income, Rick Rieder. And, of course, friend of Opening Bid, Julie Hyman here as well. Good to see you, Julie. It's always a real pleasure. I mean, you were bringing up a good point before the break, Rick, on what the Fed may or may not do. Do you fear that the economy is slowing down faster than the market realizes?
So I think, I don't know. I mean, I think the economy is in pretty good shape. I think, there's been an amazing year of people overshooting. Remember coming into this year, oh my God, the Fed's got to go 6 times, and then we got to go in March. And then all of a sudden, like, wow, maybe they don't have to, maybe they have to hike. Like I think the economy is slowing, but you've got, I mean, you look at some of the data we've gotten, retail sales, talk about Walmart, some of their numbers. You're like, boy, there's a core underpinning. Corporate CapEx is pretty good. R&D spend is pretty good. My sense is we're slowing. Slack's building in labor. Retailers generally, save some of the big, particularly online-oriented ones. So retailing is slowing. The auto dynamic is slowing. You're seeing travel, airlines, hotels slowing a bit. But boy, as long as you have an unemployment rate that is low, and by the way, a lot of focus on unemployment rate picking up. It's because so many people are entering the labor force. Pretty good for the economy. So I think it's slowing, but I don't know. I've been more enthusiastic than most about the economy, and I'm still there. Slowing, but if you said we were operating an economy, it was an A+ rating, A+ grade, I think it's a B, but it's not worse than that.
So what does all that mean for the markets? I mean, and do we continue to get a reassertion of the trend where stocks and bond prices kind of go in the same direction?
No, I think that's a change. I mean, I really think that now, I think if the economy does slow, I think you'll interpret more of the Fed moving. And actually, bonds are becoming more of a hedge now, which is we haven't seen for a long time because it's all about inflation, and they tend to to correlate with one another relative to that. Listen, I think stocks, for the first time in a while, I said this the other day, I think stocks have moved to a place that the valuations are not that great anymore. We are actually, I think now, if we build a lot of portfolios now that are 6.5% to 7% yield. We have this ETF called Bink that it's almost 7% yield. If inflation's running 2%, your real rate is pretty attractive. I look at free cash flow yield of the equity market or equity risk premium today. Boy, it's pretty rich relative to time. So, by the way, I still think equities are going to go higher. But I think some of what drove it, that's 7 stocks, their multiples are high today. So I think the needle is moving a bit to the fixed income side, of the rates side.
Well, and do you think that people will be moving as rates come down, as the Fed cuts? Do you think that folks will move all that money that's been in very short-term rates into higher income, higher yielding instruments, things like Bink or those types of vehicles?
Oh, it's definitely happening. I mean, but I wouldn't say it's a tidal wave. It is happening, but it's a persistent wave that's coming in. Listen, I mean, still getting 5% and change in bills. Cash deserves a seat at the table. I mean, that's a pretty good. By the way, because of where the market's pricing the Fed, like even the front end, like 2-year, like why give up? Cash is pretty attractive. In fact, a lot of our portfolios, I've sold a lot of investment grade credit, 1-year and 2-year stuff because I can sit in cash and clip more yield. But to lock in out to the 5-year point, to lock in 6.5 and 7 high yield, investment grade credit, agency mortgages, some of the securitized market. I think a couple of years from now, people are going to say 6.5 to 7. Like we didn't see that for 2 decades, and inflation's at 2. I think we're at a pretty pretty good point in time to get that yield on board. I've been much more bullish on equities and because of this extraordinary dynamic around tech and buybacks. But I don't know. I think I still like equities. I just think the needle now, like, this is a pretty good yield opportunity.
Well, you mentioned Bink. What's in Bink and why?
So, I mean, what we're trying to do is build a stable portfolio with a lot of yield. And so we're running today 690 is our current yield, trying to get it to 7. But we don't want to stretch. And so what we've been able to do is create a low volatility. Our volatility is half the index, the ag. It's about 2/3 that of high yield, but the yield is higher than, obviously much higher than the ag, a couple of hundred basis points. We use high yields quite a bit, but we don't want triple C high yield, which is volatile. We try to target single B in the U.S., double B in Europe. We use triple A CLOs. You can still get in the 6s for things triple A asset. Some agency mortgages, triple A, get us liquidity. And then pick away at things like securitized assets. Part of, nobody wants to buy commercial mortgages, but like office is a problem, but there are other parts of it that are in pretty good shape. Diversify it globally, keep it stable, give people, it's, by the way, it's rated, the average rating is high triple B. And so that's better than I think more than half of investment grade. So we're just trying to use all our tools to create a stable portfolio with a lot of yield.
And I mean, we have just seen an explosion in bond ETFs generally. What do you think has driven that? Is it a push or is it a pull? Is it something that people want, or is it just that there's a lot of creation of product?
No, I think we see it in our platform. When we launched this Bink, we've been running mutual funds for a while. People are still investing in mutual funds, but the ability to look at a yielding asset like a Bink and say, I'm going to put it in a model. And I'm also going to own equities. I want to own the S&P, or I want to own Qs, or I want to, it's a good building block. And so more and more people, and by the way, it's tax advantage in terms of your ability to trade it, take losses, et cetera. So works from a tax perspective, it fits in a model. And so my sense is, by the way, people talk about, mutual funds are going to go away. Absolutely not. You can do different things in mutual funds. But ETFs is a very valuable tool. The rate of growth is faster. And I think that will continue because it's a very effective building block that people utilize. And it's just obviously easy to trade them.
Julie, you flagged a good piece to me in the newsroom. Wall Street Journal looking at Gen X nearing retirement. I can't believe.
Anytime I see a headline with Gen X, by the way, I tend to click because I am.
Well, you're
Gen
not
X,
nearing retirement.
The forgotten generation, as the Wall Street Journal story called it. Hello.
Yeah. Well, you brought on mutual funds, Rick. I mean, how do you think Generation X they're going to be working longer than they thought. I mean, how do you think that influences markets over the next decade?
So can I tell you something? I've never seen this. Our generation's never seen this. When you actually look at the consumer, who the consumer is today, it is a 55 and above have become the largest cohort, which it's nice sitting in the consensus at times. So but it's actually surged higher for a couple of reasons. One, that consumer, doesn't borrow. There's actually net savers actually getting a lot of income. Part of why I think the Fed should reduce interest rates is that borrow. It's part of what keeps inflation high is that group doesn't have borrowing. They're net savers and are now spending significantly, becoming a much bigger part of the population. And I think part of why I think the consumer's in pretty good shape is that group is in very good shape today. Not borrowing, obviously got good levels of income. And by the way, you've actually seen extraordinary level of retirement because some of it is because the income levels are so good. So that has become, and not just because I sit in that zone, or I think I'm in that zone, but that has become the biggest consumer, certainly the biggest impact on markets today.
So, Julie, I need to blame you for inflation. I mean, what's up? You said you were part of Gen X. I wasn't going to say anything.
Rick. I'm not in the 55 or older, but I hope to still have my spending power. Hopefully my kids' college won't take all that away. You've been doing this for a while, Rick. So I'm curious. Also, we talk a lot to retail investors who use our platform. What do you think is still sort of the biggest misapprehension about markets on the part of retail investors?
So, thank you for saying for a while, not the number of years, because every time I think about that, it's too big. I think people tend to move with the wave. And I've said this for years that, you got to follow the wave. Consensus is right for a long time, but then the consensus tends to miss out on a lot of stuff that's going on. And I found more today than in my career, that there's this focus on, like I always say, markets can only do one thing at a time. Like something becomes hot, like we talk about oil, and like all we talk about is oil. And then we talk about AI, and that's all we talk about. It's like, I think one of the key things is for markets is when everybody's talking about one thing, like you can participate there, and oftentimes it is the most relevant thing for the aggregate market. But then, like, get off of that and think about, gosh, what are the other things that provide some real value?
So what are people not talking about right now?
So there's some value in parts of the market. Healthcare. I was watching some of was it Lilly? Some of the technology change around healthcare is unbelievable. Everybody talks about AI, but how about diagnostics? There's a bunch of companies that are really exciting around what they're doing on diagnostics, cure, et cetera. That I think is really cool. Everybody talks about the price of oil on was it down $1? Was down $2? Some of these energy companies, the free cash flow yield is like super attractive. And then, you know what, sometime over the next couple of months, people say, oh my God, oil prices are higher again, and then the stocks will do well. So I think some of those places today are really pretty interesting. And, the one that's hard is I think there are a lot of stocks with a consumer that, this haze of is the consumer going to slow, that I think a lot of those stocks are cheap. But I just don't know that we're going to get the all clear sign for a while. So they're cheap, but I think we let them be for a little bit before. Other than a couple of companies, one that you mentioned at the beginning, that are doing some really interesting things, technology-wise and otherwise.
Rick, in the minute or so we have left, someone playing volatility. What do you expect in that, I guess, last few weeks ahead of the election? What's your sense on what we might see or might not see in volatility?
I mean, because the outcome, so you think about what corporate tax rate could look like. You think about what regulation could look like. I mean, it's a pretty wide range between the candidates. And by the way, not just the candidates inclusive of what Congress could look like. Do you have, does one of the candidates have, or does the Republican sweep, which people are debating. Listen, volatility is going to be high, liquidity is going to be low, opportunity set's going to be robust. I think, part of, we talked about it like that last Monday. We did a lot of trades. I look back and said, gosh, those were good trades, but like too small. Because you think about it. Remember, S&Ps were down 120, 180, 250. I mean, I bought some at down 250, and I looked like, why didn't I buy more? Because it looked like it go down 350. I mean, so I think it'll be the same paradigm. It's like, I think you got, as an investor, you got to say, okay, here are my ranges. Here's where I buy. Here's where I sell. And you got to stick to your... you got to be dedicated to, here are my ranges, because the noise is going to be intense, and you just got to try and separate yourself and be pragmatic around it. But it's going to be, I think it's going to be a fun time because it'll be a ton of opportunity.
I always feel bad asking you on, Rick, because I just want you to get back to markets. Like, we've had you here for like 26 minutes.
Well, we're outside of his busiest
I need to get Paul Rick back to these markets.
Longest time without my phone.
All right, let's get you out of here. Really awesome insights, Rick. Thanks for you for always giving Yahoo Finance time. We really appreciate it and really always enjoy your insight. Julie Hyman, again, one of the stars of the market domination. Please be sure to watch that every afternoon starting, 3 o'clock, Julie?
Yes.
3 o'clock on Yahoo Finance. You can catch Julie Hyman and Josh Lipton. And that's it for the latest opening bid.